Yo, what's up, guys? If you look at the stock market right now, the S&P 500, the QQQ are pretty much at all-time highs right now, literally less than 1 or 2% off all-time highs. And I want to recommend some stocks that are actually at good and fair valuations that are worth buying today. There's a lot of stocks out there that I love, but the multiples are too expensive, like Robinhood with a 50 plus forward PE, AMD with the 50 plus forward PE, SoFi. So there's a lot of really expensive companies, but I'm going to recommend some companies that are a bit off all-time highs, and I'm not just recommending them because they're off all-time highs. I'm recommending them because they're good quality, financially sound companies that I think are worth owning for the long run. So let me share with you what picks I have in this video, and if you would, please drop a like for me. I'd really much appreciate that, and let's just get straight into the video. So this first stock I want to share with you that I absolutely love is ticker symbol SFM, Sprouts Farmers Market, and we are down bad. We are down 25% on our position right now. They don't pay a dividend, but they make up for it in share buybacks. I kid you not, they've bought back 25% of all the shares just since 2019. So they're an insanely shareholder-friendly company in terms of that. But this is a grocery store right here. Sprouts Farmers Market is like a healthy grocery store, and the one thing you focus on is their net margin. You look at Kroger's net margin; it's lucky to be at 2%. Costco's is at 3%, and this one has abnormally high margins for the industry. That's because they sell more healthy-oriented stuff as Sprouts Farmers Market, and I love their net margin, and they're expanding it. That's the real winner here, the net margin expansion. So if we go to the revenue right here, first off, this is good growth, double-digit growth. It just hits a new record every year, every quarter. So they're growing very nicely in terms of the top line. But the revenue's up 17, but the net income is up by 40%. Again, that's because of the net margin expansion, but this is good money. And what are they doing with like this 100 mil plus a net income a quarter? Well, check this out. Here's what's so cool about this company. They also, I believe, have no net debt. If we go to their cash on hand, they have $261 million of cash. And if we go to their total debt right here, total debt of $8 million. So they have a lot of net cash, like $200 million in net cash. And since they don't pay a dividend, guess what they've been doing? If we go to their total, actually, this is the number you want to look at, the diluted weighted average shares. That includes stock options and stuff like that. It's better than the total common shares outstanding. But check this out. In the most recent quarter, there is 98 million shares. If we go to 2019, let's see. 2019, it was 118 million. Look at these year-over-year declines. There's not many stocks that I know that buy back their shares this aggressively. Like, they bought back 5% of all the shares this year, another 5% this year, another 3% this year. So they're going crazy on the share buybacks. They've slowed it down a little bit because the stock has been so high and a little bit expensive, but it's finally come down to a good valuation where I think they're going to be buying back more shares. So if we go to their diluted normalized EPS, check out the growth here for just a boring grocery store. This is insane. The EPS is up 41% after it grew 44. There is no declines over here until we go back to 2021, where the whole market was in a bit of a dip. But the growth ever since on their diluted normalized EPS, the number you want to look at, is phenomenal. We can actually see the exact amount they spend on their share buybacks. Yeah, look at that. This quarter they spent 80 million. Last quarter they spent 218 million on share buybacks. And again, they can easily afford that. They're making easily over 100 million in net income a quarter. We can go to the free cash flow per share as well, or just the cash flow down here. It's also easily over 100 million a quarter. So from a fundamental point of view, I really like Sprouts Farmers Market, and I'm a believer that fundamentals outshine in the long run, and I love their numbers. Now, I will say Sprouts Farmers Market is kind of being out-innovated by Amazon and Walmart. Again, they're not two healthy grocery stores. They're not focusing on the same person, but they have like an online presence where you can get your groceries delivered to you. I'm not sure if Sprouts Farmers Market will deliver your food to you, or I'm not sure. And I'm pretty sure anything you can get on Sprouts Farmers Market, you can most likely get on Amazon. I'm not sure. But anyway, I just like their numbers. I love the buybacks. I actually like that they don't pay a dividend, because that gives them more money to invest in the future. Maybe they can do M&A or something. So from a fundamental point of view, it's an attractive, I'm down 25%. So I might be looking to nibble on a little bit, like maybe one more share, just get this up to an even 10 shares. But yeah, look at how crazy the stock price has been, and it's finally at a reasonable time to maybe buy. And again, a lot of the grocery stores have been struggling recently, like Kroger as well. But anyway, that's Sprouts Farmers Market. That's our first pick. They don't pay a dividend, but this next stock I'm going over does pay a dividend. And the yield is pretty low, but here's the thing. They also pay a yearly special dividend. It's pretty cool. And this stock is well off all-time highs. All-time highs was 290. Now it's 240. This is an insurance company. And again, I'm not just recommending them because they're off all-time highs. I'm recommending them because they're a good, fundamentally sound company. Check out the growth here. Revenue's up 21, after it grew 18, after it grew 33. Like the growth has also just been insane the past couple years. They're on a streak. And also, not just revenue, but net income. Look at the net income growth. It's at a record this quarter, 3.2 billion in net income. This is what's so cool about that. The fact that they made a record net income quarter makes me believe that this next special dividend that they're going to do is going to be insane. So last January, they issue it, they do the X dividend right at Christmas in December, and you get your actual money on 118. But oh no, that's the X day. Anyway, this special dividend was 75 cents. The next one was $4.50. Again, they normally only pay you 10 cents a quarter, and it's always been 10 cents. They don't raise, there's another $1.50 special dividend. They never raise their normal 10-cent dividend, which I actually like. I like that about them. I like that they just choose to do a special dividend at the end of the year, because then they can invest in the company and they're not committing to a super high payout ratio, but they still reward you whenever they can with that special dividend every year. And I think that this next special dividend is going to be a record. So yeah, the yield is only 0.1, but when you include the special dividend, the yield gets to over 2.5%. If you buy the stock right now, not financial advice, you should probably get a 2.5% dividend yield, maybe more. But yeah, the net income growth is insane. 3.18 billion in the most recent quarter. And let me actually check if they're doing share buybacks. I'm not sure. Well, they're not, but you've been diluted 0.07%. So they're not diluting you, but they're also like not issuing any shares. So that's good news. The total debt is 6.89 billion. Remember, they made this quarter over 3 billion in net income. So they pretty much have no debt, call it. Yeah, look at this. So their normal dividend only costs 59 million a quarter. They made 3 billion just this quarter, and look at their yearly special dividend. It costs 2.69 billion. That's only the last quarter it was 505 million. That's when they paid a special dividend. So that's pretty cool. That's what I just really like about this stock. So anyway, they're shareholder friendly. They're in a nice industry, and the revenue keeps growing. Their margins are expanding. Let me actually double check their margin real quick, then we'll get to the last stock here. But yeah, look at their net margin, 14%. Look, it's never been 14% before. That was a record margin. I haven't seen that high of a margin ever on Progressive. So they absolutely deserve this. And also not just the EPS, which is this right here. Again, EPS is $5.40, $4 to $5 of EPS a quarter. Look at the free cash flow per share. It's way significantly higher, and it's also really growthy. It's up 23% after 39. Like there's no declines for the past 2 years here. So this company is on a growth streak. Again, tech is on fire, and when tech is doing good, some of the defensive names, like insurance is kind of a defensive industry, kind of like McDonald's or something, and kind of like the grocery stores as well. I'm kind of recommending a lot of the stocks that don't do good in a bull market, like the safety stocks, Progressive, grocery stores. All right, guys, for this last stock here, this is one I see nobody ever talk about, but in my opinion, this is the best drink company. They actually sell beer. They own a bunch of brands you probably know, and I actually just bought a little bit more of this company. I bought, let me see right here. I bought 3 shares I bought $150 of this stock a few days ago. So let me tell you why I bought more of this company. They're a phenomenal dividend growth company, in my opinion. If you look right here, they have a 4% dividend yield, and look at the forward PE versus trailing 12 months PE. So they're already trading at 9 times net income. Again, it's probably fair for this industry. They just sell a commodity, but look at the forward PE. It goes down. That implies that they're expected to grow their net income, basically grow their EPS. And check this out. This is the best part about this company. Again, they're a bit of a slow grower. This industry's in some water right now. So this is why they deserve to kind of be at this price right now. They deserve to be on this kind of nasty downtrend, because the growth is gone. Look at this. The revenue's down 1.5 after falling 0.4. So the growth is gone. But again, all their competitors are seeing the same sort of decline, but the margins are still here. Like they're still printing money easily. If you average it out here, easily over 250 million in net income every single quarter. So let's just say that they're making 250 million plus a net income every single quarter. Again, subject to change, obviously. Let's go see how much the dividend cost. The dividend only cost 93 million, and look, the dividend cost last quarter 99. And it went to 93. How did the cost of the dividend go down? Well, that's because they bought back so much of their own shares. And when you buy back your own shares, you don't have to pay dividends to those shares anymore. So the cost of the dividend goes down. The EPS goes up. It's incredible. So look at this. This is the best part, is how shareholder friendly they are. You own 4.5% more of the company after you own, like these are the share buybacks. Like there's 198 million shares. Let's go to 2019. Or 2020. It was 216, or all the way to 21. It was 216. Now it's under 200 million. Like that's 8% plus. Like that's insane how the share buybacks are doing. And they're not just buying back their own shares, but again, they're also paying a dividend. So not only do you own 4.5% more of the company via share buybacks, but you also have gotten a 4% dividend. That's what's incredible. You get a 4% yield here. So this is kind of a nice dividend share buyback play. Again, we do want to see the sales growth come back. That's the big risk here. You know, revenue's down 1, net income fell by 0.2, but that's actually really impressive that they kept their margins. So I do like this industry. Again, they just sell a commodity, but I think it's a fair valuation, especially with the share buybacks, the huge yield. Again, I don't expect this company to outperform in the long run. This stock is the same price that it was back in 2014. Yikes. So do beware, but the share buybacks and the dividends look attractive. And those are you buy this if you're looking for a nice yield. So anyway, and some maybe dividend growth in the future. Hopefully they'll do some M&A. So anyway, that was the video, guys. I hope you have a great rest of your day. Let me know what stocks you think are at some fair valuations. I'll make sure to check out all the comments. And yeah, dude, another stock I'll mention is McDonald's. Definitely one I'd also include on the list, but I don't want to take up too much of your time. This is really a real estate royalty company. So anyway, hope you have a great rest of your day. My name is Nathan Robert. Check out this video up here. I think you'll really like it. And also, we stream daily if you want to check out the streams. And I'll see you later.